We can go ahead and get started. Welcome everyone to today's Transportation Committee webinar on the IRA tax credit and direct pay provisions. Welcome everyone. You can feel free to put your questions in the Q&A box and we will address those after the presentation. But my name is Delaney Dixon. I'm the Senior Program Manager here at NASEO working on clean transportation. We are joined by Jason Prince of Giraffe Financial. Jason spent the last 12 years working in regulatory markets for clean technology, and in his most recent role has been focusing on consulting entities on the Inflation Reduction Act IRA tax credits. So we're really excited to learn more about these tax provisions as it pertains to EVs and how state energy offices can take advantage of these opportunities. So I'll hand it over to Jason to take it from here.
Thank you so much, Delaney, and it's really a pleasure to be with you all today. My name is Jason Prince with Giraffe Financial. I'm the CEO and co-founder, and what we're here to talk about today is the Inflation Reduction Act and the tax credits that it represents. The whole takeaway I want you to leave with is that while it is tough to deal with the IRS, getting IRA tax credits does not have to be, and that goes for really any type of entity that wants to take advantage of it. They are able to, and they can do so. There's a lot of support resources, and that's what I want to talk through today. Really quickly, I've basically done my whole career in state regulatory markets. Everything's from renewable portfolio standards and then renewable energy credit markets through to things like low carbon fuel standards and LCFS credit markets. I worked in structured finance at a solar developer called Solar City and then Tesla, where we worked in tax credits. So it's just another regulatory mechanism that incentivizes clean technology deployment. We launched Giraffe Financial a year ago because we were so focused on the Inflation Reduction Act. We saw that it represented the most important opportunity for decarbonization in this country's history. But we also recognize that a lot of the regulatory complexity might inhibit the taking advantage of the credits by some of the organizations that it was actually intended to support. So there was this unfortunate paradox where the IRA represents, over $1 trillion, but it might not actually get taken advantage of because there's all these barriers to entry, so to speak. As it relates to this transportation committee, I'm focusing the presentation today largely on electric transportation. However, I have a few slides at the end that talk a little bit more wider aperture about other things that are relevant for the Inflation Reduction Act. So I'll start at a high level. What is the Inflation Reduction Act, or the IRA? It's this landmark piece of legislation that was passed in 2022. It goes into effect as of Jan 1, 2023, and it goes for 10 years. So it's all the way through to 2032. And it's uncapped funding. So there are projections of what it's actually going to represent in terms of the federal funding. Those projections are over $1 trillion. However, there's no cap. It's not like there's a firm amount of money that's earmarked. Unlike, for example, a grant program where there's a certain amount of money, it's a bucket, and when that's depleted, there's no more. With the Inflation Reduction Act, really all eligible clean technologies that are deployed over the course of the 10-year period for the IRA will be able to take advantage of these tax credits. When we think about just what that represents for clean transportation, it's expected to be over $380 billion. And that's really for the vehicles and the charging or refueling infrastructure associated with it. Again, an amazing opportunity that we've never seen before. However, the fact is that the incentives are over 70% structured as tax credits. So the vast majority of the IRA money comes as tax credits. And so to take advantage, you must deal with the IRS, which isn't everyone's favorite thing to do. I realize that. So there's a couple things that are really, really exciting that happened with the IRA. And the first one is the direct pay provision. The IRA actually included 2 new options to monetize tax credits. There's always the same option of you can use the tax credit yourself, but there's been some issues with that in the past. The first issue is that some entities don't pay taxes, so they can't really take advantage of a tax credit. For example, I developed solar and storage a number of years ago for rural electric cooperatives. And as much as they were utilities, they knew and wanted to own and operate those assets because they couldn't take advantage of the tax credit. We had to structure a very complicated third-party power purchase agreement, and it was a whole pain. What the IRA did is it introduced this new option called direct pay, which what it does is it allows those types of entities to receive cash from the IRS for the same value as the tax credit. It's kind of hard to believe because most non-taxed entities, if you're tax exempt, if you're a state, if you're a local government or an agency or a nonprofit, tribal nation, a rural electric cooperative, like I mentioned, you do not pay taxes. And so it's hard to believe that you can actually take advantage of a tax credit. That's what IRS did with direct pay. It said that all of these tax exempt entities can submit tax forms. So they have to deal with the IRS. They have to go through the IRS process. But if they do that, the IRS will essentially consider it as if they had paid more taxes than they should have, and they will issue a tax refund. In the same way where me personally, if I were to have not, you know, paid more taxes than I should have, if I didn't withhold enough taxes, I paid a ton of taxes. The IRS at the end of the year will look at what I submitted and in my tax return, and they'll give me a cash refund. So some people get excited when they get their cash tax refunds. That's basically what all tax exempt entities are now able to do through direct pay. So it's a really, really exciting opportunity, and especially for this audience, I think that's the most relevant. And so that's what we'll really be focused on is direct pay. Kind of sounds too good to be true, but it is what it sounds like. You get a direct payment from the IRS. I do want to acknowledge, though, that there was an additional really exciting provision in the IRA called transferability, which is also a new option. And what transferability is this opportunity for taxable entities, whether you're a C Corp, an S Corp, LLC, or etc., those types of entities can actually sell tax credits to a third party. That's really important because some entities are not able to take advantage of those tax credits themselves. If they claim them, they could really only take advantage of them if they had tax liability. But if you don't, now you can actually go ahead and just sell them to a third party. So for many organizations within your states, they may want to pursue direct pay. And for many other organizations, they may want to pursue transferability. Now, thanks to the IRA, all of these options are available. I'd like to discuss some of the specific incentives that are included for clean transportation. I'm going to first start with the vehicle side of things. Many people may be familiar with the personal tax credits for electric vehicles. These are things like if you purchased a Tesla, you can get up to $7,500. Those are really exciting and expected to drive a lot of consumer adoption for personal use of those vehicles. There's in particular the 30D credit for new electric vehicles, and there's also the Section 25E credit for used electric vehicles. When we think about what that incentive amount is, I want to clarify that there are calculations required. It's not exactly as simple as saying you get this dollar value. There is some math that's required that the IRS has provided, which can be found at the links that I included here. And this, I think, presentation will be made available so you can see those links yourselves. But for the purposes of kind of broad brushstrokes for this conversation at a high level, you can use the heuristic of getting up to $7,500 for the new vehicles under 30D and up to $4,000 for the used vehicles under 25E. You may also be familiar with the rules associated with these tax credits for personal use. There's an MSRP cap, so the vehicles have to be under a certain cost. The income limits are actually incumbent on the owners, whoever is purchasing those vehicles. They need to not be, super high earners. The final assembly has to happen in North America. There's requirements on the actual vehicle's make and model and the components that go into it as well. So, and those vary by the credit, but it's a lot more restrictive, I would say. People who might think they can take advantage of that $7,500 for a Tesla sometimes are, unfortunately, shocked to find out that, oh, they're not eligible for it. and how those credits are claimed, you can file independently, but there's this really nice provision where as of 2024, the dealers of those vehicles can actually get the credits transferred to them at the point of sale and provide what's quote unquote called colloquially cash on the hood. So when you purchase the vehicle, you get that money right away. So those are the personal vehicle credits. What I think is more relevant and what we're focused on at Giraffe Financial, and what I expect people are going to be more interested in for the sake of this conversation, are the commercial credits. This is a new, very exciting tax credit called 45W. Again, there's a calculation that's required, but to simplify for purposes of this call, it's a similar value in the incentive amount for the light duty vehicles. So if you're under 14,000 pounds for gross vehicle weight rating, so most light duty vehicles, you can get up to $7,500. For 24, that's the number you'll get. However, what's great about the commercial tax credit, one of the things is that there's also these incentives up to $40,000 per vehicle for medium and heavy duty. And this goes all the way up to class 8. From the state level, if you have fleets of fire trucks, if you have things like waste management, all types of vehicles can actually take advantage of these credits. And you'll notice there's a lot less rules. I did not include all the rules for the personal credits. There's actually quite a few more. For the commercial credits, it's actually much more straightforward. You can kind of get around a lot of the issues that create bottlenecks for the personal credits. Mainly, the vehicles must be subject to depreciation, which just shows that you're using them for business purposes. It's a business commercial asset that you depreciate. And the OEM, the original equipment manufacturer who manufactures that vehicle, must be on the IRS qualified manufacturers list. It's a simple list that's, again, linked at the Section 45W IRS website. You can look at that list and make sure that the OEM is on it. And if so, you as the owner can take advantage of that tax credit. How to claim those credits, you need to file some paperwork. I'll talk about that actually on the next slide. So for commercial EVs, the 45W credit, there are actually rules that are incumbent on both the OEM and the owner, whoever purchases that vehicle. The OEM, like I mentioned, they must become a qualified manufacturer. If you want to be able to take advantage of the 45W credit, you must be able to see that OEM listed on the qualified manufacturers list. And one of the requirements of being a qualified manufacturer is that you submit regular reports to the IRS that show things like the vehicle identification numbers, etc. Now, for the owner of the vehicle, and to be clear, the owners of the vehicle, and this is consistent for any IRA tax credit, you have to be the owner to claim the tax credit. That's who the credit actually goes to. So that owner has a number of steps to follow. The entities that are just doing direct pay have to do an extra step. So for the vehicle credits, the 45W vehicle credits, if you're a tax exempt entity that's going to take advantage of direct pay, you're going to file your forms with the IRS and they'll pay you basically cash. There's a hoop that you must jump through, which is called a pre-filing registration process. The IRS has put forward a portal, so it's actually an online process. You go in and essentially the year that you're placing vehicles into service, let's say in 2024, you would go in to the IRS portal and you would say, hey, I purchased these many vehicles and I'm going to go ahead and move forward with the direct pay provision. So I'm going to receive the cash from the IRS when I file my tax forms in 2025 for all the vehicles I placed in service in 2024. And then what will happen is the IRS will give you a registration number that says, okay, we acknowledge that you have said you're purchasing these vehicles in 2024 and you're going to claim them when you file your taxes in 2025. And then you basically take that registration number. And then when you file your taxes in 2025, you go ahead and you include that registration number and you submit the relevant forms. So anyone who's going to claim a 45W tax credit, any owner of a vehicle that's being used for commercial purposes, has to file the form 8936, and there's an associated Schedule A, and also the form 3800. It's the general business tax credit form. So everyone's going to fill in those two. Entities who are direct pay, so if you're a tax exempt entity, there's one additional form that you must submit called the 990T. I'll note that, again, there's this confusion oftentimes with tax exempt entities who say, wait, we don't file taxes. How do we do this? Like, I don't know when I'm supposed to file my taxes. And the good news is the IRS is aware of this, and they're trying to facilitate the process for tax exempt entities to get involved in the process. So there's a lot of flexibility that they provide in terms of, even if you're on a fiscal year and you want to file your taxes on a calendar year, so you can take advantage of everything that you placed in service, you can do that. More details, and happy to discuss that in the Q&A. I'll also note that in general, anyone who's filing things with the IRS, you're required to maintain audit records. And that basically just means documentation of, for example, the vehicles that you purchased, the purchase price, when you place them in service, things like that. One other caveat that's really important, because I imagine this is very relevant for state and local government fleets, is that many of those are leased. As I mentioned earlier, the owner of the asset, whether it's a vehicle or any, charger or solar or storage, the owner gets the tax credit. So what happens in the case of a lease? Is it the lessor or is it the lessee? Who actually gets the credit? Well, it's not so straightforward. It actually depends on the terms in the lease agreement. So I have a link down here where the IRS considers a tax owner for purposes of the tax credit claim someone based on its facts and circumstances determination of what the lease term, what the lease agreement actually has to do. So just because you're leasing, if you're a municipal fleet, for example, you're leasing vehicles, or you're a Department of Transportation and the vehicles are all leased, that's okay. You still may be able to move forward and claim the tax credits. You just need to make sure that the terms of the lease agreement match what the IRS requires. I'll move now to the association with the electric vehicles. We'll also talk about charging infrastructure. On the charging infrastructure side, the relevant tax credit is the 30C credit. Again, there's a bit of a calculation that's required, but for simplification purposes, you can consider the heuristic that you can claim up to 30% of the total cost of installation for chargers with a cap of $100,000 per charger. When I say the total cost of installation, I'm including both the hardware, how much do the chargers themselves cost, but also the total cost of installation in addition to like the actual, the labor and the mechanics, the trenching, any infrastructure upgrades from the utility side of things, anything like that. One clarification I should make on the electric vehicle side of things on the slide that I previously mentioned for the 45W, it's relevant for electric vehicles. It's also relevant for fuel cell electric vehicles. For the charging infrastructure, it's relevant for the 30C tax credit. It's relevant for electric vehicle charging. It's also relevant for refueling of low carbon fuels. That includes everything from, compressed natural gas to hydrogen to ethanol 85. Lot of refueling infrastructure property is also included in 30C. I think what we're seeing most in the market right now is electric, so that's what we're focused on. Some of the rules for the electric vehicle charging infrastructure are more complicated than the electric vehicles. As I mentioned, for the electric vehicles, really you just double check that the OEM is on the qualified manufacturers list and you can claim the credit. For the charging infrastructure, you have to think a little bit more about how you're siting the charging because there are geographic constraints. Historically, we've seen a lot of chargers get installed in urban and affluent areas. So the policy intention of the Inflation Reduction Act with the 30C tax credit was to start sending federal funds to different areas. And I think this is really nice from an environmental justice and from an equity standpoint. Again, from state energy offices, this is very relevant for you in terms of how you can drive investment into areas that might have not yet received as much investment. So the 30C tax credit is only eligible for certain census tracts, and those are non-urban, or if they're urban, they must be low income. From a policy perspective, the Inflation Reduction Act also wanted to ensure that this federal funding created opportunities for a green workforce that was well paid. And so to get the full 30% tax credit, you must demonstrate that the installation of the infrastructure actually was done by individuals who were paid prevailing wages, and that apprentices were used on the actual installation. So we're creating a good new workforce. Those rules are relatively complicated. However, if you follow them, they're very lucrative. The compliance obligations, again, are incumbent on both the installers to go and follow those rules, prevailing wages, and using apprentices. That's, it's not 100% required. If you don't, you can get a 6% tax credit. But to get the maximum value to quintuple from 6% to 30%, which everyone's really wanting to do, the installers must follow these rules and then document all of that so that you can have that audit trail for the sake of the audit records. And then the owners of the charging infrastructure, they must go through some similar hoops. Now, you'll notice that the pre-filing registration for the owner is actually relevant for both direct pay and for transferability for the 30C tax credit. So for the 30C tax credit, you can transfer if you're a taxable entity and you don't want to claim the credit yourself, you can sell that credit to a third party for the 30C. If you're direct pay, if you're a state entity or another local or governmental entity or agency, you're tax exempt. So the option for you is direct pay. There's another set of forms that are relevant for the 30C tax credit. For example, there is the 8911 and the 3800. And then the 990T is the same form where if you're a tax exempt and you're doing direct pay, you always need to file out that 990T. Now, I really wanted to focus on the clean transportation side in terms of the vehicle credits and the charging or refueling infrastructure credits for this conversation. However, I do want to flag just for a minute that the IRA provides similar, very lucrative incentives for things like renewable energy or energy storage, and those would fall under the Section 48 tax credit. There's also a 45 credit for wind, but for what it's worth, they're similar for renewable energy. And the idea is, again, a calculation is required. But what's really exciting about the Section 48 tax credit is you can get up to 70% of the cost of installation covered by tax credits, assuming you meet all of the rules. So those rules, again, you get a kind of a 6% base tax credit, which you can bump up to a 30% tax credit if you follow prevailing wage or apprenticeship. People use this expression PWA as an acronym for prevailing wage and apprenticeship, so you might hear that term colloquially. And then above the 30%, you can actually get additional bonus adders. And those relate to things like energy communities. Is the siting of the renewable energy or energy storage project in a community that was impacted by, for example, a brownfield or mining or oil and gas? There's an additional 10% credit you can stack on top. And that comes for using domestic content and things like, for example, on the solar, the steel that goes into making the racking. And then in addition, there's a competitive process where you can bid into these solicitations for low income. And if you're in a low income community, you can get up to 20% as a bonus. So when you add all of these together, 30% for meeting prevailing wage and apprenticeship, 10% for energy community, 10% for domestic content, and let's say you got the allocation for the low income, you can get 70%. So it's pretty remarkable in terms of how much value you can derive from the Inflation Reduction Act. Briefly speaking, there's similar rules for the renewable energy 48 tax credit as there is for the 30C charging or refueling infrastructure credit. Some of the things that are really nice, though, are if you're doing smaller scale projects, there's this PWA exemption. So you do not have to worry about paying prevailing wages or using apprentices if you're a small system. Under 1 megawatt is the threshold. The owner of the system has very similar compliance obligations in terms of following the pre-filing registration. For Section 48, if you're tax exempt, you'll do direct pay. And if you're taxable, you have the choice. You can either transfer your credit or you can claim the credit yourself. And then the forms are similar. The 3800 you'll start seeing as familiar, as is the 990T. And then the source credit form is the thing that really varies by credit type. If all this sounds complicated, I'm with you. I understand and I appreciate it, and you're certainly not alone. The good news is that organizations like Giraffe Financial were launched really to streamline this process for everyone involved. Our organization specifically provides services to try to make this a painless process, and we do the end-to-end servicing of the IRA tax credit, where we help organizations everything from working with state energy offices and corporations to provide education and marketing materials so that entities can understand what opportunities exist within the Inflation Reduction Act, all the way through to working with OEMs to get them registered on those qualified manufacturers lists and submit those regular reports. And then from the entities that own the credits, we help determine eligibility, calculate the credit amount. We'll do pre-filing. We'll do all the relevant tax form preparation so people can really just claim the credit without worrying too much about it. I want to emphasize one point, and this is really my last slide. I really do believe, from spending so many years working with state level regulatory constructs, states and energy offices within states have a crucial role to play here. And with the Inflation Reduction Act, it's this amazing federal funding opportunity that energy offices can help leverage to pull those federal funds into their state's economic development and really drive the clean economy in your state. There's a couple ways I can flag to do this. The first is via providing technical assistance. So, specifically direct pay entities, it's the sad paradox where there's this new provision, direct pay, we're trying to collect all of these tax exempt entities that never were able to take advantage of the incentives. And we want to allow them to take advantage of it. But it's really complicated. They've never paid taxes. They don't know what to do. So I think the opportunity for state energy offices to step in and say, hey, these organizations need technical assistance. They're doing a lot of this stuff. We have fleets. We have tons of fleets of vehicles. We have tons of infrastructure for charging. We want them to take advantage. Well, there's some good examples. I want to give a major kudos to Washington Department of Commerce. They released an RFP for tax credit assistance where they're actually asking for a nonprofit organization and in consortium to support the education and actual monetization of tax credits by entities within their state. And so they're basically providing some state money to pay organizations kind of upfront to make it easier for any entity in their state to take advantage of those tax credits. So I think that's a really excellent precedent. Major kudos to Washington, and hopefully other states may follow suit. The last thing that I would say that energy offices can do to really make it easier for organizations within their state to take advantage of the Inflation Reduction Act tax credits is they can address some of the upfront capital constraints. There's a ton of opportunities for financing support. One thing that I'll note for things like direct pay is the entities, like I said, you have to own the asset to claim the tax credit. So to own the asset, you need to spend money today. Let's say you're purchasing these vehicles. You need cash today to purchase those vehicles to install that charging infrastructure. And then you'll file your tax credit form next year when you file the taxes. Let's say you install it in 2024, 2025 comes around, you fill in your tax forms. The issue is you might need money up front. You might not have enough money in 2024. If you're a nonprofit, for example, in the state, you might not have cash. So state energy offices can step in there. They can provide bridge financing. They can say, hey, you're purchasing an eligible electric vehicle. We know you'll get a tax credit. Why don't we give you some cash today so you have money to purchase that vehicle? And then once you get the tax credit next year, you can repay us. So financing can come through things like the green banks, revolving loan funds, other financing vehicles. There's a lot of different things that you can do. But I just really want to emphasize that I think that the IRA, again, it's uncapped. We don't know how much value it's going to be. We think it represents over $1 trillion. It could be zero. If people don't place these assets into service and don't claim these tax credits, all of this potential funding will literally just be left on the table. So there's this incredible opportunity. There's organizations like Giraffe Financial. There's many other nonprofits who are working in this space. I'd like to give a shout out to groups like Lawyers for Good Governance, WRI. We know Electrification Coalition is doing work like this. There's a lot of really great organizations trying to put out a lot of really great resources. But I think that the whole thing swivels on the state energy office is really pulling that in-house. So that's it for me today. Please, if anyone has any questions to follow up, we can talk through it today. You could also look at our website. You can reach out to me directly. It's really an honor. I've been a big fan of NASEO for many years, and thank you all for the opportunity to chat with you. And I'd love to go back to you, Delaney, and see if there's any questions to discuss.
Great. Thanks, Jason. This was really informative, and it looks like we have a lot of questions in the Q&A box so far. So the first one is, how do 45W and direct pay differ, if at all? So I'm guessing that would be the standard tax credit versus the direct pay option.
Thank you. Yeah. So the way I would think about it is direct pay is kind of an umbrella. So a direct pay is an umbrella that says if you are a tax exempt entity, and that could be anything from, public sector, so a state, Department of Transportation, it could be a port, it could be an airport, it could be a local government, a community-based organization, it could be a nonprofit, it could be a tribal government. There's a lot of different categories. It could be a school, a university, a hospital. If you are one of these types of entities and you're tax exempt, and that's kind of a confusing term, if I could clarify, tax exempt just means you don't file federal income taxes. If you don't need to do that on an annual basis, if you're not filing income tax, you are considered tax exempt. And what that means is you are eligible for the direct pay provision. And that's the umbrella provision that basically says if you submit your tax credit forms to the IRS, they will give you a direct payment. That's why it's kind of called direct pay. Under the umbrella of direct pay, there are a number of different tax credits that people can take advantage of. So if you're a direct pay entity, any of those types that I mentioned, let's say you're a state Department of Transportation, you're eligible for direct pay. And then let's say there's an electric vehicle that you purchased. You can claim the 45W credit, which is the credit for electric vehicles. You could also claim the 30C tax credit, which is the credit for charging infrastructure. You could also claim the 48 tax credit, which is the credit for renewable energy, things like solar energy or things like energy storage. So as an umbrella term, direct pay just means you're able to pursue this election where the IRS will pay you directly, and you could use that election for any of the actual assets or infrastructure that you deploy.
Great. And to clarify, is direct pay the same as elective pay, or are those different?
Those are synonyms.
Okay. Yeah.
Yeah,
Oh, a
sorry,
lot of terms.
people call direct pay colloquially, but yeah, elective pay, it's interchangeable.
Got it. Okay. You're electing to be paid. Got it.
Exactly.
All right. Next question. When is the deadline, or what would the deadline be for completing the pre-filing requirement?
Great question. So the IRS suggests that you submit the pre-filing registration 120 days prior to your tax filing. Let me give an example to make this a little bit more practical. Let's say let's say you purchased in 2023 some electric vehicles. Again, most tax exempt entities that are going to pursue direct pay, they're not filing their taxes. What you can do is you can basically elect when your tax filing deadline is going to be. And for most of those entities, it's going to be November of 2024. So in 2023, you purchase some electric vehicles. 2024 comes around and you file your taxes for 2023. That tax filing deadline is November 15th. You have to look 4 months prior. So 120 days or 4 months prior would mean that if you need to file your 2023 taxes in November of 2024, then you need to do your pre-filing registration in July of 2024. So then 120 days gets you time where the IRS will review your pre-filing registration. They'll give you a registration number, and then you'll go and submit your actual tax filing November 2024. And that'll be your tax filing for the 2023 tax year. And maybe just like one more sentence, because I realize it's a little confusing. You can kind of think about it like how you do your personal taxes. So for example, 2023 just happened, and I filed my personal taxes by April 15th of 2024 for my 2023 tax year. Some corporations file on an extended timeline where you get a 6-month extension. So that's kind of why we can get to the November timeline. For a tax exempt entity, your filing dates are usually going to be May or November for the year prior. So in 2024, either in May or November, you'll file your 2023 taxes. I hope that makes sense. I'm sorry that the timeline is a little confusing.
Yeah, makes sense. Next question, is direct pay only available to tax exempt entities for the 45W credit?
So for 45W, you can take advantage of that credit if you are a tax exempt entity, in which case you would do direct pay. However, if you're a taxable entity, you can still claim that credit. You just can't transfer it. So the way to think about this, like it's kind of the earlier question, the umbrella direct pay, you can kind of just equate. When you think direct pay, think tax exempt. Those are basically one and the same things. If you're tax exempt, you only have that option. The only option you have is to do direct pay, which is frankly, it's a very good option. You just get a check, which is really nice. If you are a taxable entity, so let's say you're a C corporation or you're a LLC, whatever you are, you pay federal income tax. You typically have two options for how to monetize credits. You can either claim them yourself, or for some credits, you're allowed to transfer. If you're a taxable entity, some credits you can transfer, some you cannot. 45W, unfortunately, you cannot. You have to claim that yourself. The 30C credit for the charging or the 48 credit for the renewable energy, if you're taxable, you actually have both options. For 45W, you really only have the option to claim it yourself.
Great. All right, next question. Just to confirm, the 30C credit can include front of meter infrastructure.
Yes. So for 30C, they use this kind of calculation where you take 30% of the cost of installation. So when we think about what is the cost of installation, behind the meter, front of the meter, the tax basis, like what is included in that dollar value? You take 30% of what dollar value? You can include any of the infrastructure that is considered integral for the operations of that charging infrastructure. So if you couldn't, let's say you're doing a greenfield site, you can't place an electric vehicle charger there unless you have, a substation that's going to provide power. You can't have it unless there's going to be some switch gear, for example, or there's going to be, a transformer. So that type of stuff, and let's say you have to pour a concrete pad, you have to do some trenching, that type of infrastructure, front of the meter, behind the meter, that can be included in the tax basis.
Great. All right, next question. Is there a chance that entities eligible for direct pay for vehicles do not get the funds because the dealers built the benefit into the upfront cost?
So for the commercial tax credit, no, the dealers are unable to take advantage of that credit themselves. It's really the owner of the vehicle who can claim that credit. So I will say, this kind of goes back to leasing. Sometimes, depending on the nature of the lease agreement, the dealer or the lessor, the entity who's leasing you the vehicles, they might claim the credit themselves and then bake in the value of those credits to a lower lease rate. But if someone is, if a dealer is selling you a vehicle, they cannot claim that credit themselves. It's really you as the owner of that vehicle for tax purposes. You're going to be depreciating that vehicle. You are the entity that's eligible for the tax credit.
Great. All right. Now we have a question about depreciation. Does a depreciable cost basically just mean the fueling station itself? Yeah.
Yeah. So the depreciable basis of these assets will be reduced by the value of the tax credit. And then in terms of what you depreciate, like what is the amount that you depreciate? Yeah, that would be, so in the case of 30C, it would be the cost of the asset that you're going to hold on your books. So, when it goes back to the earlier question of who holds what assets on their books, if you are, going to own and operate that substation, that could be, if you're a rural electric cooperative, for example, and you're going to build that infrastructure, that could be part of your tax basis. And so your depreciable basis would be inclusive of that. I hope that addressed that question. I don't know if I fully understood if someone wants to follow up, I'm happy to take that one a bit further, but I think I've covered that.
Yeah, and if anyone, if you have a question that you'd like to elaborate on, feel free to let us know in the chat, and I can unmute you if you'd like to elaborate off mute. Now, it looks like we have a question about the prevailing wage and apprenticeship requirements, if you're able to talk a little bit more about that requirement.
Yeah, absolutely. And it's frankly, it's a really good question because, I think as you've gathered from this presentation, it's one of the most significant hoops that you must jump through to really take the maximum advantage of these IRA tax credits. Again, if you don't follow prevailing wage and apprenticeship, the tax credits are, 6%. If you do follow prevailing wage and apprenticeship, you can boost that, you quintuple it 5 times to 30%. That's the value. So, what are those requirements? On the prevailing wage side, what it means is every jurisdiction will actually have their own prevailing wage, and it's based on a trade code. So, for example, an electrician would have, its own trade code. And then based on that electrician trade code, if you're in, Manhattan, New York City, or if you're in, Missoula, Montana, it'll be a different prevailing wage. Those prevailing wages can be sourced from the federal website, from sam.gov. And it's really as simple as that, as kind of looking it up. Some jurisdictions might not have a prevailing wage, or some trade codes might not have a prevailing wage already in the register, in which case there's a process you can go through where you actually request one. So there's some kind of fine print there. But one thing that I would say, especially from the perspective of state energy offices, people may or may not be familiar with what's called Davis-Bacon Act requirements, which are essentially for public works project, any public works construction project. There's a requirement to pay prevailing wages to those workers who are involved in the construction. And so Davis-Bacon Act requirements have been around for a long time. I think a lot of installation contractors are familiar with it. It's similar in the Inflation Reduction Act, but there's some additional tweaks. One of the main things that we're finding is apprenticeship is actually the binding constraint. So whereas people are pretty familiar with prevailing wage and apprenticeship, when we talk to installers all day, I'll try to explain them the rules. And when I say Davis-Bacon, people are usually like, oh, yeah, I get it. What they're not familiar with is the apprenticeship rules. So the apprenticeship rules essentially state that for a specific year, so if it was 2023, it was 12.5%. For 2024 and beyond, it's 15%. That's the percent of hours of time that workers spend on the project that must be served by registered apprentices. And so what you need to do is you essentially need to demonstrate that you've tried to find an apprentice who can work that 15% of hours on your project. And so all across the country, there are these registered apprentice agencies, and you try to reach out to them and you try to say, hey, I'm doing this job. We need an apprentice. Sometimes the installer might actually have their own registered apprentice program. Other times they might need to reach out to third parties. I can say that this has been one of the, this is the thing that we're working with a ton with our customers on. And what we're finding is most of them are pursuing what's called a good faith exemption. And what that basically means is that, the sad reality is there's not that many apprentices that are doing things like EV charging today. It's an industry that the Inflation Reduction Act, through these rules, is trying to really kickstart. But there's this good faith exemption where if you reached out to a registered apprentice agency and you can document that you sent an email requesting an apprentice, even if you don't get that apprentice to come and do the 15% hours because there aren't any available, if you can demonstrate that you at least tried, you used good faith efforts to try, you can still count it and still get that 30%. But that's really what it comes down to. It's like paying the people, and it's really anyone involved, any mechanic or laborer who's involved on site doing the installation, pay them the relevant prevailing wage for their trade code and jurisdiction, and use apprentices for a specific number of hours. And what I can tell you is the Giraffe platform, one of the big value propositions we have is managing this PWA process. It unfortunately has been rather cumbersome for folks to understand. We try to streamline this by actually including contract language. So for every customer that comes on our platform, we provide them with contract language that we suggest they include in their bids So we say, hey, if you're running an RFP and people are going to bid to do this work, the general contractor is going to bid to do the work, make sure that in the RFP you include this clause that says the contractor will follow all the Inflation Reduction Act PWA rules and will provide documentation to demonstrate compliance. And then we basically work directly with those installers to make sure that they are following the rules and that we collect the right documentation. It's such a big difference to go from 6% to 30%. We really encourage it, both from an economic standpoint and from a workforce development standpoint.
Great. All right, the next question is around an energy office operating a rebate program for both EVs and charging infrastructure, balancing wanting to encourage people to utilize these tax credits, but not wanting to over incentivize. So what can entities, or what do they need to know they can expect to receive from the IRS? Do they need to submit an estimate of the project cost on the pre-filing?
Yeah, thank you so much. That's a really great question. I should have addressed that earlier. So at a high level, grants, rebates, other incentives that states may provide to incentivize clean tech deployment, they play nice with tax credits in the sense that you can actually combine them. I really appreciate the point about you don't want to over incentivize, and that's actually exactly embedded in the design of the tax credits. So you can use as an heuristic the equation grant or rebate plus tax credit cannot equal more than the total cost of installation. And if it helps, maybe I can give a quick illustrative example using some numbers. Let's say you installed an electric vehicle charging station and it cost you $100. Assuming you followed prevailing wage and apprenticeship when you installed it, you'd be eligible for a 30% tax credit, assuming that it was in an eligible geography. Let's say you get a 30% tax credit, so that's $30 of tax credits. $100 cost of the system, $30 tax credit. Let's say that that charging system had received a $70 grant or rebate. They have $30 that they paid out of pocket. And since they have a $30 tax credit, they can use that $30 tax credit. So the $70 grant plus the $30 tax credit equals $100, which was the cost of their system. So great, they just got a free EV charger. And I could actually point to a ton of examples where we're doing this, specifically for folks like electric school buses. They're trying to take advantage of state and or federal funding from the EPA to purchase the buses and purchase the charging. And there's some out-of-pocket additional expense. They can take the tax credit to do so. I'm going to give a second scenario based on the same example. The second scenario, the charger cost $100, so $30 tax credit. But instead of a $70 grant, let's say that the state was so generous. Thank you, state energy offices, for being so generous. Let's say you provided an $80 rebate or an $80 grant. In that case, $80 grant plus $30 tax credit, that equals $110. That's more than the cost of the system. So you can't actually take all of that. What you would have to do is you would have to reduce the value of the tax credit to the $20. So you'd have an $80 grant, and then you can still get a $20 tax credit. But basically, the heuristic is the tax credit can only net you your out-of-pocket expense. You can't combine the tax credit with grants and get, free cash. I wish you could. Unfortunately, that's not the case.
Great, that was a good example. So it looks like we have a little under 10 minutes left. I want to get to the last few questions here. We have one. Do you have any best practices on how to use these credits as match toward federal grant programs? How can state agencies that administer federal funds encourage subrecipients to use tax credits as a match? Or is it too complicated that you'd advise a state to not encourage this?
These are really fantastic questions. It's so nice to have an engaged group that's kind of in the weeds on this. I think it's a fantastic idea to include tax credits as match. Honestly, it comes down to the individual program. We've, as Giraffe Financial, we've had some conversations with state agencies encouraging them to do so. Particularly for the underserved groups out there that just don't have match. It's like, even though you can get a grant, there's cash flow issues because, maybe the grant comes in the form of a rebate. So you have to pay money today and then get money later. So it's really just hard for them to capitalize things. If they could pledge the tax credits as part of the match. That just makes it easier. It really alleviates their upfront capital needs and allows more underserved organizations who might not have as much resource to move forward. So really the opportunity to do so depends on the specific program and whether or not you can include match or not. And that's kind of just dependent on how those rules are written for that program, whether it be a grant or a rebate. But I think it's a great thing to consider. We have seen some examples, in particular in California, we've seen some examples where in the grant or the rebate program, they're actually asking, how are you leveraging federal funding? And I think that's a great precedent that others hopefully will follow suit.
All right. Can the state be held liable if the subrecipient overclaims the tax credit, like in your example?
No, I mean, ultimately, the IRS, if they ever were to audit someone, would audit the person who claimed that tax credit. So it's really, I don't feel like the state could be held liable in any way. The liability just rests with whoever's making that claim. So, certainly when we work with people, our job is to do the calculation of how much tax credit you can get. So we're always trying to figure out, okay, what other incentives did you take advantage of? And let's make sure that all together we calculate this accurately. So, if you work with a third party like Giraffe, like we would do that. Otherwise, you could, entities who own the assets could work with their CPA firm to make sure that they're doing it appropriately. But I don't think there's anything to worry about in terms of liability from a state perspective. There's nothing that would be backed, that would go back to you.
Next question goes back to direct pay versus transferability. Is transferability limited to only certain entities to apply for or make use of?
Yes, transferability is only available for taxable entities. And it's kind of like, if I may, I might just come back to this first slide for one quick second here. There's kind of like when I was mentioning the umbrellas earlier, it's kind of like a decision tree, maybe is a better metaphor here. Um, if we and it's kind of like maybe instead of reading left to right, if we started reading right to left. So if we start with the who, if you are a taxable entity, you're able to take advantage of transferability. You're not able to take advantage of direct pay. And then the inverse is true. If you are a tax exempt entity, you can only take advantage of direct pay. You cannot take advantage of transferability. So transferability, when you can kind of think about it this way, like when you think transferability, think taxable entity. When you think direct pay, think tax exempt entity. It's really, you're only able to take advantage of one if you're the other. Who determines the what? If you're taxable, you can do transferability, or you can claim the credit yourself. You kind of have two options if you're taxable. You can transfer or you claim it. If you're tax exempt, you can't claim a credit because you're not filing taxes, so you can't use a credit to offset your liability. You don't pay taxes by definition, you're tax exempt, but you can do direct pay.
All right. Are dealerships required to offer point of sale option to consumers? So I guess this would be for the consumer credit.
Yeah, so it's not a requirement. Dealers can opt into it, and I want to clarify the dealers come into play as it relates to the personal vehicles. So dealers can, for example, for the 30D tax credit, if they're selling new electric vehicles, they can, if they register with the IRS, offer this cash on hood point of sale transfer where they basically say, hey, I'll reduce the purchase price by $7,500 and I'll go and deal with the IRS on your behalf. Unfortunately, that cash on the hood option does not exist for the 45W or the commercial credit. So if a vehicle is going into service for a commercial application, that owner of the vehicle must file the taxes. And again, that's where, like, from Giraffe Financial's perspective, we are focused on 45W because we realize there's some extra work there. The IRS kind of eliminated that work for the end user, the owner of the vehicle on the personal side, but did not eliminate that amount of work for the commercial side. And so that's where the owner still needs to fill in the forms, and we're happy to help with that.
All right, looks like we have one more question. What if a consumer does not have federal tax liability for the $7,500 for the EV? Will they be able to receive the $7,500?
Yeah, so as an individual, like if you're purchasing a vehicle for personal use, let's say you don't have any tax liability this year, you're not paying any taxes at all. You can bank that credit, so to speak, and carry it forward so that if in the future you have tax liability, you can use it to offset. And I should caveat, I know 100%. We actually at Giraffe Financial, we're not really focused on the personal side because I feel like the IRS made it pretty easy. It's just this, dealers have opted in because it makes it easier for them to sell vehicles. So the dealer solves it. I know definitively for the 45W commercial tax credit, you can actually carry that credit backwards by 3 years. So if you pay taxes in 3 prior tax years, you can actually go and get a rebate for, refund for that. Or you can carry that tax credit forward by 22 years. So it's considered a general business tax credit. So it's pretty nice. My understanding is that the same things apply for personal, but I want to be clear that I'm not 100% sure because that's not the area that we focus day in, day out. We're more exclusively focused on the 45W for the vehicle.
All right, we have time for one more question because it's a good one. Can the direct pay be designated to another entity by the tax exempt entity? For example, a green bank or financing organization provides a bridge loan. Can that tax exempt entity have the IRS send the tax credit to the financing organization?
That's a really good question, and like there have been some kind of commentary on this and ongoing rulemaking discussions. The short answer is no. The IRS will have to pay the owner, so the IRS would pay the direct pay entity who owns that asset and files for it. However, there's certainly nothing wrong with that direct pay owner, that entity who's going to purchase, let's say, the vehicle, and received a bridge loan from a green bank or a state revolving loan fund or something. They could say, hey, when I get that money from the IRS through direct pay, I'll repay you. There can certainly be some contractual obligations there that they can kind of handle, but you can't really tell the IRS to pay some third party instead of you. The funds have to flow to you.
Makes sense. Well, thank you, Jason. This has been a really informative presentation and really, really good discussion and questions from the group. So I can imagine they can contact you with questions. You all can contact me as well, and I can get you in contact with Jason, and we will be sure to share the recording with you all later in the week or the next few weeks as well. But thank you again for taking the time to present to the group and for the great discussion.
Thank you, Delaney, and just like huge thanks to NASEO and really to all the participants for everything that you do. Really grateful for the opportunities that you create for your state entities to take advantage of these incentives and drive the clean energy economy. So appreciate everyone. Thanks. And don't hesitate to reach out.
Sounds good. Thank you, everyone. Bye-bye.